trade that damages you most is often the one you entered only after every indicator finally agreed. The chart looked orderly. The signal appeared complete. Yet by the time you felt certain, the market had already transferred its risk to you. That is the hidden cost of confirmation. It can make a late decision feel like a safe one. There are no tools that always produce winning trades. Uncertainty does not disappear because a chart becomes crowded with evidence. But there are indicators that always win the argument because they measure what the market is actually doing, not what you need it to do. The distinction is easy to overlook and expensive to ignore. An indicator derived from price cannot command price. It can only describe what has already occurred. When you forget this, you begin trading the description instead of the event. A crossover becomes a reason to buy even as price fails to advance. An oversold reading becomes a reason to fight a decline while sellers remain in control. The calculation may be correct, yet your interpretation can still be wrong. So watch the market's response, not merely the signal. If price breaks resistance, notice whether it can remain above it. If volume expands, observe whether the expansion produces meaningful progress or merely violent activity. If momentum rises, ask whether buyers are gaining ground or paying increasingly higher prices for increasingly smaller advances. Effort without result often reveals more than strength without context. This is where trader behavior enters the chart. A failed breakout is not just a failed pattern, it is a group of buyers trapped above a level. If price returns there, some of them will sell simply to escape. A rapid recovery after bad news is not merely a candle formation, it suggests that available supply could not force the market lower. Cause creates behavior, behavior creates pressure, and pressure eventually becomes visible in price. Your task is not to predict every turn. It is to recognize when the evidence confirms your idea, and when the market is quietly refusing it. Avoid adding new indicators simply because the first signal has become uncomfortable. That habit does not improve analysis, it conceals invalidation. Before entering, identify what price must do if your reading is sound. After entering, judge the trade by that behavior. Is the market progressing within a reasonable time? Does it hold important ground? Does opposition appear and then weaken, or does every advance meet heavier resistance? These observations will not remove risk, but they can keep a small error from becoming a defended opinion. The phrase, "3 indicators always win," is therefore not a promise of certainty. It points toward 3 forms of evidence that overrule every forecast, every theory, and every attachment you bring to the screen. To use them properly, however, you must first understand what each one reveals, and what their disagreement is warning you about. The words, "always win," are dangerous in trading because they invite the wrong expectation. They suggest a tool that cannot fail, a signal that sees farther than everyone else, or a method that removes uncertainty. Nothing in a living market can offer that. Any indicator presented as a machine for guaranteed profit should be rejected before its settings are even discussed. Yet the phrase contains a useful truth when you understand what is actually winning. A trader can have a careful forecast, a sound explanation, and a strong opinion. None of these has authority over the market. They are interpretations formed before the outcome is known. The market is the event itself. When observation and expectation separate, expectation must give way. That is the sense in which certain evidence always wins, not by making every trade profitable, but by having the final word over every theory. This distinction matters because prediction and authority are not the same thing. An indicator may fail to predict the next movement and still reveal that your present interpretation no longer fits the evidence. Its value is not limited to saying what comes next. Sometimes its greatest value is showing that the story you brought to the chart has lost its right to guide the decision. Consider the order of importance. First comes the market's actual behavior. Beneath that comes your reading of the behavior. Beneath that comes your forecast. Trouble begins when this order is reversed. The forecast becomes the master, interpretation becomes its servant, and every new piece of information is judged by whether it supports the original belief. Once that happens, analysis is no longer measuring the market, it is protecting an idea. The 3 indicators in this framework, price, participation, and time, are not being offered as a secret combination. They are three forms of observable evidence. Each answers a different question about what is taking place, but none promises to tell you exactly what will happen next. Their authority comes from their connection to market action, not from any claim of certainty. That authority also has limits. Evidence can be incomplete. It can arrive late. It can appear clear and then change as new trading occurs. A disciplined trader does not solve this problem by pretending uncertainty is absent. You solve it by keeping every conclusion conditional. If the evidence changes, the conclusion must be allowed to change with it. This requires precision in the language you use with yourself. This market must rise, leaves no room for correction. The present evidence supports a rise, recognizes both the case and its limits. The first statement demands obedience from the market. The second demands attention from the trader. One creates a fixed claim, the other remains answerable to what unfolds. So when you hear that three indicators always win, do not translate it as three signals that always make money. Translate it as a hierarchy, observed behavior above interpretation, interpretation above prediction. The purpose is not to become certain. It is to know which evidence has the right to overrule you. The first of those authorities is price. But before its message can be understood, you must stop treating every upward or downward movement as if direction alone were the message. A market can travel a considerable distance without proving that it belongs there. That is why direction alone is a poor reading of price. An upward move tells you where price went. It does not tell you whether the higher area was accepted. A downward move shows displacement, but not whether sellers established control. Acceptance begins when the market can conduct business beyond an important boundary without being forced back through it. Price crosses the area, remains on the new side, and treats that side as a place from which further movement can develop. The important fact is not the crossing. It is the market's ability to preserve what the crossing achieved. Rejection produces a different structure. Price enters new territory, finds no lasting support there, and returns inside the former area. The excursion may have looked decisive while it was happening. Once the gain is surrendered, however, the market has revealed that the apparent advance did not change the accepted area of trade. Think of the difference this way: movement is an attempt, acceptance is the result. Markets are always testing prices. Some tests discover willingness to continue doing business at a new level. Others discover that the new level cannot be maintained. If you treat every test as a completed decision, you will repeatedly mistake exploration for commitment. Location gives these movements their meaning. A large candle in the middle of an established area may alter very little. A smaller move through a boundary that has repeatedly turned price can alter the structure considerably, provided the market holds beyond it. Price should therefore be read in relation to the ground already established, not admired as an isolated shape. This is also why a level is not simply a line on a chart. It is an area where prior decisions were made. When price returns, those decisions are tested. If the market moves through the area and later finds support on the other side, the old barrier may have lost its influence. If price cannot remain beyond it, the boundary has demonstrated that opposition is still present. The consequences extend beyond the chart's appearance. Acceptance gives traders a new reference point for judging value. Rejection leaves positions established during the failed move under pressure. Those traders may exit when price turns against them, adding force to the return. The structure changes because earlier decisions now create later action. To read this clearly, begin with 3 price, only observations. Mark the area from which a meaningful move previously began. Watch how price behaves as it enters that area. Then examine what remains after the attempt. Has the market preserved new ground or surrendered it? This sequence carries more information than the simple fact that the level was touched or crossed. Avoid giving too much authority to one dramatic bar. A single bar records a portion of the contest. Structure records what the contest changed. Look at the approach, the test, and the condition left behind. When these parts tell a coherent story, direction gains meaning. When they do not, the movement may be little more than temporary displacement. Price can therefore show you where the market is willing or unwilling to remain, but price alone cannot reveal how much participation stood behind that decision. The next question is not merely whether the market moved, but how much effort was required to produce the result. A sudden expansion in volume attracts attention because it appears to announce importance. The bar grows, activity surges, and the market seems to be speaking with unusual force. But force alone does not tell you which side gained control. Volume records how much business was done. It does not declare what that business accomplished. Every completed trade contains both a buyer and a seller. For that reason, high volume cannot simply mean there were more buyers, and low volume cannot simply mean there were more sellers. Volume measures participation. Price reveals the consequence of that participation. Only by reading the two together can you judge whether the effort produced useful progress. When activity expands and price covers substantial ground in the same direction, effort is producing result. Buyers may be consuming available offers during an advance, or sellers may be pressing through bids during a decline. The movement does not become certain or permanent, but the relationship is clear. Increased participation is being converted into displacement. The more revealing condition often appears when effort rises but progress contracts. Heavy trading enters the market, yet price gains little ground. This suggests that aggressive orders are meeting enough opposition to prevent an easy advance. Someone is supplying what buyers demand or absorbing what sellers offer. The volume shows the struggle. The limited movement shows that neither side is passing through without resistance. This is why a high volume advance is not automatically bullish. If extraordinary activity produces only a small gain and price finishes far from its best level, the market has spent considerable effort for a poor result. That does not prove an immediate reversal. It tells you that the apparent strength carried a cost, and that opposition was stronger than the direction alone would suggest. Low volume requires the same discipline. A market can move a surprising distance on modest activity when little opposition stands in the way. Such movement may look weak because participation is limited, yet it can continue while opposing orders remain scarce. Conversely, low activity with little movement says almost nothing beyond the absence of urgency. The meaning comes from the result produced by the available effort. Volume must also be judged relatively. 10 million shares can be extraordinary for one instrument and ordinary for another. Even within the same market, raw volume has little meaning without a recent baseline. You are not asking whether the number is large in isolation. You are asking whether participation changed noticeably and what price accomplished after that change. On each meaningful bar or sequence, examine three things. First, compare the activity with what has recently been normal. Next, measure the distance price actually traveled rather than the drama of the movement. Then, observe where price finished within that distance. A wide advance that finishes near its upper extreme shows a different result from the same volume ending near the middle or the low. Suppose, hypothetically, two advances cover the same distance. The first requires ordinary participation and finishes near its best price. The second requires exceptional participation, but gives back much of the gain. The destination is similar, but the internal condition is not. The second move consumed more effort and encountered more resistance. Equal movement does not mean equal strength. Do not ask volume to predict by itself. Ask a narrower and more useful question: how much effort entered, and what did that effort purchase? That comparison turns volume from a decorative histogram into evidence of efficiency, resistance, and pressure. Even when effort and result appear aligned, however, the market still faces another test. Genuine pressure should not merely produce movement, it should produce progress within a reasonable span. That brings the third authority, time, into view. A trading idea can weaken while price remains almost unchanged. Nothing dramatic appears on the chart. No obvious boundary has failed. Yet the condition that justified the trade may already be losing force, because the expected movement has not arrived when it was supposed to. Every trade contains two claims, whether you state them or not. The first is a claim about direction. The second is a claim about time. You expect a market to move a certain way, and you expect the reason behind that movement to matter within some useful period. If the second claim is ignored, almost any stagnant position can be defended indefinitely. This matters because a genuine imbalance should produce a consequence. If demand is meaningfully stronger than supply, price should eventually respond. If selling pressure has control, lower prices should follow. When the expected result repeatedly fails to appear, one of two things is likely: the imbalance was weaker than assumed, or an opposing force is containing it. In either case, elapsed time has exposed a weakness that direction alone may not show. Time does not prove that the market must reverse. A stalled long position is not automatically a short, and a delayed decline is not automatically an advance. The message is narrower. The original premise expected pressure to express itself, but that expression is absent. Confidence should therefore decay, even if the visible price structure has not yet broken. There is also a practical cost to delay. Capital remains committed, attention remains occupied, and exposure continues while the market provides no return for carrying that uncertainty. A position that goes nowhere is not free simply because it has not produced a large loss. It consumes the one resource that cannot be recovered from a trade opportunity. The correct time allowance cannot be borrowed from impatience. 5 bars may be too long for one idea and meaningless for another. The clock must come from the premise itself. If the setup depends on immediate pressure, hesitation carries information. If the premise allows for development, a longer pause may be ordinary. The question is not, am I tired of waiting? It is, has the market exceeded the period in which this idea was expected to prove itself? That distinction keeps time analysis objective. Emotional waiting is measured by discomfort. Market waiting is measured against an expectation established before the delay begins. Without that expectation, the trader moves the deadline whenever the position becomes inconvenient, and time loses all analytical value. Before acting on a setup, define a reasonable window for the anticipated behavior to begin. It need not be a rigid countdown, and it should not force an automatic decision at an arbitrary bar. Its purpose is to create a point of review. Once that window is consumed, the premise must earn renewed confidence rather than receive it automatically. At that review, examine the claim in its original form. Was the opportunity based on pressure that should have appeared promptly? Has the market delivered any meaningful portion of the anticipated movement? If the same setup appeared now, with the delay already visible, would its timing still support the idea? These questions separate a position that is developing from one that is merely being carried. A forecast that becomes correct far beyond its useful window may still have been a poor trade. Directional accuracy cannot erase the cost of an undefined wait. In trading, being eventually right and being right in a usable way are different achievements. Time therefore acts as a test of urgency, but its message does not always agree with what price or participation appears to suggest. When one form of evidence confirms the idea and another withholds confirmation, the problem changes from reading indicators separately to deciding how their disagreement should be handled. The three forms of evidence will rarely align with perfect clarity. One may support the trade, another may remain neutral, and the third may begin to weaken the case. This is not a flaw in the framework. The disagreement is often the most informative part of the reading. The mistake is to treat the indicators as 3 equal votes. 2 bullish readings do not automatically defeat 1 bearish reading. Each indicator answers a different question, so each can expose a different weakness. A market may reach the expected area without showing commitment, or show commitment without producing useful progress. Counting signals hides the specific condition that is missing. Disagreement means the thesis is incomplete, but incomplete does not always mean false. There is an important difference between evidence that has not confirmed and evidence that has directly contradicted. Neutral participation, for example, may leave a price move unproven. Participation moving decisively against the apparent direction creates a more serious objection. Silence and refusal are not the same message. This distinction prevents premature conclusions. When one indicator remains neutral, the market may still be developing its case. When one indicator actively opposes the other two, The market may be exposing a transition in control. Neither condition gives you permission to predict the outcome. It tells you how much certainty the available evidence can honestly support. The order in which evidence appears also matters. Market behavior unfolds as a sequence, not as a completed picture delivered all at once. One form of evidence may change before the others respond. If you demand perfect agreement at the same instant, you may wait for a picture that appears only after the useful information has passed. If you accept the first sign as complete confirmation, you may act before the rest of the case exists. The proper question is therefore not, do all three agree? It is, what exactly does the disagreement leave unresolved? Perhaps the market has moved but has not demonstrated commitment. Perhaps commitment is visible, but the expected progress is absent. Naming the missing condition gives you something observable. Calling the setup mixed gives you only a vague feeling. A strong thesis should be separable into three claims. The market must occupy the right ground. The move must have meaningful support behind it. The expected pressure must express itself within a useful window. If one of these claims is essential to the setup and the market refuses to satisfy it, the entire thesis cannot retain its original strength merely because the other two remain favorable. Not every missing condition deserves equal weight. Some are required, others are supportive. That distinction must be made before the evidence becomes confusing. If expanding participation is essential to your premise, its absence matters. If it would only strengthen an otherwise valid idea, neutral participation should not be treated as a contradiction. The importance of an indicator comes from the claim being tested, not from a fixed scoring system. In application, classify each reading in plain terms: supportive, neutral, or contradictory. Then identify which category is preventing a complete case. Do not combine the readings into a single number. A score conceals meaning. 3 written judgments force you to see whether the problem is weak support, active opposition, or simply unfinished development. Then define what resolution would look like. Neutral evidence must become supportive, contradictory evidence must cease, or the original thesis must be reduced to a different claim. Until that happens, disagreement is not something to explain away. It is a condition to observe. But the same disagreement does not carry the same weight in every kind of market. What appears abnormal in a steady trend may be ordinary inside a range, and what looks decisive during quiet trade may be insignificant during expansion. Before the 3 indicators can be judged together, the environment interpreting them must be understood. The same indicator reading can be useful in one market and misleading in another. The calculation has not changed. The market's operating condition has. When context changes, what counts as strength, weakness, urgency, or hesitation changes with it. A regime is not a prediction about where price will go. It is a description of how the market is currently conducting business. Some markets are moving directionally. Others are rotating around an accepted area. Some are contracting into narrow movement. Others are expanding with unusually large swings. Each condition establishes its own standard of normal behavior. In a directional market, progress tends to build upon earlier progress. Countermoves occur, but they fail to erase the main advance or decline. Under these conditions, a pause may represent temporary interruption rather than loss of control. Reading that pause as immediate failure ignores the larger tendency of the market to preserve directional ground. A balanced market follows a different logic. Movement away from the center often attracts an opposing response, and neither side maintains control for long. Evidence that would support continuation in a trend may carry less weight here, because extension is not the market's established habit. The same apparent strength can lead only to another rotation. Compression changes the meaning again. Ranges contract, participation often becomes subdued, and progress becomes limited. These conditions are not automatically signs of weakness. They describe a market in which neither side is pressing hard enough to create expansion. Judging compression by the standards of an active trend will make normal quietness look like failure. During expansion, the opposite problem appears. Large bars, forceful movement, and abrupt reversals become common. A dramatic reading that would be exceptional under quiet conditions may be ordinary inside an expanding market. If every large movement is treated as decisive, the trader assigns special meaning to behavior the regime is producing routinely. Event-driven trade can temporarily disturb every recent baseline. Information enters, expectations are repriced, and normal comparisons lose some of their value. Activity that once looked extreme may become standard for the new condition. Until the market establishes a fresh pattern, old measurements can remain mathematically accurate while becoming contextually stale. This is why indicator thresholds should not be interpreted as permanent laws. A fixed number may describe the calculation consistently, but it cannot explain the environment surrounding it. The market decides what is unusual through comparison with its present behavior, not through loyalty to a setting chosen in advance. Before interpreting any reading, identify the market's current habit. Is price preserving directional progress, returning repeatedly toward a central area, contracting into smaller movement, or expanding into wider movement? Do not begin by naming what you hope the next move will be. Begin by describing what the market has repeatedly done. Then define what would be normal inside that condition. In a trend, normal may include pauses that leave the main structure intact. In balance, normal may include failed extensions and repeated returns. In compression, muted readings may be expected. In expansion, unusually large readings may no longer be unusual. Context becomes useful when it creates a clear standard for comparison. Regimes also change, but one bar should not be allowed to rename the entire market. A genuine change alters the pattern of behavior. Directional progress begins to fail repeatedly. Balance stops pulling price inward. Contraction gives way to sustained expansion, or disorder settles into a new structure. The classification should follow the evidence, not react to every disturbance. The most difficult period is transition, when the old regime is weakening, but the new one is not yet established. Mixed behavior during that phase is not a puzzle that must be solved immediately. Sometimes the correct classification is simply uncertain, and the indicator readings deserve less confidence until a stable condition appears. Even a well-identified regime cannot prevent surprise. It only improves the meaning of the evidence already present. Once that evidence supports a trade, another question becomes unavoidable. If the market still behaves unexpectedly, how much should the idea be allowed to cost? A sound market reading can justify a trade, but it cannot decide how much the trade should be allowed to cost. Analysis answers whether an opportunity may exist. Risk architecture answers whether you can participate without letting one uncertain outcome damage your ability to continue. The first part is invalidation. Before entering, you need a market condition that would make the original thesis no longer reasonable. This is not simply a price that feels uncomfortable. It is the point where the behavior required by the idea has failed. Without that point, the trade has no defined boundary. It has only an entry and a hope. That boundary must allow for ordinary movement. Markets rarely travel in a straight line, even when the larger reading is correct. If the invalidation point sits inside normal fluctuation, the trade can be removed while its underlying premise remains intact. If it is placed so far away that the thesis could fail long before the exit is reached, the boundary offers protection without discipline. The location must belong to the idea itself. Once that location is known, the financial consequence can be defined. The distance between entry and invalidation tells you how much each share or contract would lose if the idea fails as planned. Your tolerable loss then determines the position size. This order matters. Market structure sets the distance, and financial limits set the size. Reversing that order creates a common distortion. A trader chooses the desired position first, discovers that the proper invalidation point would cost too much, and moves the stop closer to make the numbers fit. The chart has not changed, but the protection has been placed where ordinary movement can reach it. The position size has quietly rewritten the market thesis. The cleaner solution is to reduce size when the required distance is wider. If even the smallest practical position would create an unacceptable consequence, the trade is not suitable under those conditions. Passing on it is not a judgment about its direction. It is recognition that a valid idea and an acceptable exposure are separate requirements. Strong evidence should not be used to excuse excessive exposure. Confidence can influence whether a setup deserves consideration, but it cannot turn uncertainty into certainty. Increasing size beyond a tolerable limit because the indicators appear unusually persuasive makes the cost of being wrong depend on conviction rather than capacity. Risk also includes the relationship between what must be exposed and what the market could reasonably offer. If the invalidation distance is large while the available objective is limited, the trade may require too much loss potential for too little opportunity. A high probability cannot be assumed simply to repair poor asymmetry. The structure must make sense without inventing an exceptional outcome. The application is straightforward. Identify the exact market behavior that would invalidate the premise. Place the protective boundary beyond that condition with enough room for ordinary fluctuation. Measure the distance from the intended entry. Then calculate a position size that keeps the planned consequence within a predetermined financial limit. If those pieces do not fit together, the trade is not properly constructed.